So how do people use whole life insurance in a recession? Because when you look at whole life insurance, specifically the cash value component, when we talk about a recession, this is one of the most popular areas to put money. If the policy is set up right, where I actually see high cash value from start to finish. But why it's so popular in a recession is because when I've got economic uncertainty or the economy's in the toilet, things are going down, maybe the stock market is down as well, and I'm looking for somewhere safe to put my money where I actually see it grow. It's also liquid, so I can take advantage of opportunities in a down market. If you're a business owner or real estate investor, you know that that is the best time to be liquid, a down market, because you can acquire assets at a discount compared to what they are available for right now. So what a lot of people like to do is put money in whole life insurance because it is a safe, liquid, and tax-free area to position money. This answers the why as to why people put money here. It's safe in the sense that the money continues to compound, regardless if things are going very, very well in the stock market and economy, or if things are going very, very poorly. I like to refer to it as a peace of mind product. No matter what happens, the value just continues to appreciate over time. Number two, it's liquid. I have access to the cash value for anything that I want, but what we'll see a lot of people do is use it for opportunities. When I combine these two, it gets very powerful because now it continues to appreciate. I can access it, and remember, when you access the cash value in a life insurance policy, you continue to receive compounding on your entire bucket of money. We'll look at an example of that in a little bit. And then three, the tax benefits. If you do everything right, I can access the cash value tax-free. If you do everything right is the key. We've got a video above that provides more detail on that. So what we see a lot and what we've seen over the years is people who typically keep money just in cash, money in the bank, will move some of that into a whole life insurance policy where the cash value is maximized. They do that, again, because it's a safe area that they can position money. They'll continue to grow. But on the liquidity piece, how it's often viewed is one will say, well, I can use my cash value as a line of credit instead of acquiring an asset in cash or going to a bank, which delays sometimes occur. I've got to deal with the bank's terms. If I want to be able to move fast, this is a nice place to have money and see it continue to appreciate when I use it. Again, we're going to look at an example of that. It's easy and also fast. Business owners, real estate investors, that is extremely important. Here we've got real estate correction. This is just a popular example of people we see wanting to acquire real estate in a down market where I can acquire property at a discount if the real estate values have come down in my area. So we're going to look at an example of how someone can use a policy. We'll look at an example we're actually preparing right now. It's for a 60-year-old individual. He's got $600,000 in cash. What he wants to do is move that into a policy over 4 years. That's a total of $150,000 per year. On the cash value growth, this question always comes up, and if it doesn't come up, it is important to ask, what's the number one drawback? Here it is right here. The first year is the worst year with a whole life insurance policy. Even when it's designed for maximum cash value, which is what you're about to see, the hit is going to be somewhere between 10 and 20%. The range depends on the company and product that you're looking at. But what that 10 and 20% means is if you pay $10,000 into your policy and you've got $9,000 in cash value in the first year, that means you had a 10% hit in the first year. That is the worst year of a policy. If it's not designed properly, that gets worse. That could be as low as 0% in the first year, which I definitely would not recommend. Then we've got policy loans. So a quick example here. If you've got cash value of 100 grand, say it's earning 5%. If you borrow $50,000 and have $50,000 remaining in cash value, what would you earn that 5% on? Or what do you think you earn that 5% on? The full 100, even though you've pulled 50K? No, most would say the 50K. However, with a life insurance policy, you continue to earn that 5% on the full $100,000. There's no lost opportunity cost. It's just like borrowing against real estate. If you owned a piece of property and the fair market value appreciated by 5% every single year like clockwork, if you have a line of credit or if you take a mortgage out against that property, doesn't matter what the loan balance is, that'll affect your remaining equity. However, you continue to receive that appreciation on the full property value. Almost the same thing with the cash value of a whole life insurance policy. How that works for the insurance company is, one, you do have a cost to borrow, the loan interest that goes to the insurance company on whatever the outstanding loan is. And then second, the death benefit. When you take a loan, you will see your death benefit drop dollar for dollar by the loan amount. We'll look at an example of that in a little bit. First, we'll analyze this. Moving cash into a policy over 4 years. Here's what we got. Pretend this is you for a moment. Annual outlay is the net dollar amount you're moving into the policy. The two columns to the left provide a breakdown of where your money is going. So of that $150,000, we see the premium is just under $19,000. That's a combination of what is called the base premium, which is at a true 10%, $15,000. And then we've got a term rider for the other $3,700. Purpose of a term rider, cheap way to raise the death benefit, which prevents a MEC, which is a taxable event. If you'd like more details on that, we've got them in the video above. But the premium is minimized. We want to minimize that because that is what takes the biggest bite, so a little Pac-Man, of the first year cash value. So the more we can reduce that, the less the bite is. We want to make that small so we don't feel that pain, because this is the reason why people are not interested in whole life. Typically is the reason the upfront cash value hit. So here, first year, there's still a hit even though we minimized it. So we minimize the bite. The rest of our dollars go into our PUA rider. PUA stands for paid up additions. I like to refer to this as a cash dump-in. Okay, but total out of pocket $150 per year. First year cash value $132. That is just about an $18K hit, which comes out to about a 12% loss in the first year. Now, year one, you're at $132. You add $150 to it. If you had $132,000 under your mattress and you added another $150 to your mattress, what would your mattress then be worth? $132 plus $150 is what? $282. What's it worth? $275. You got your $150 back minus about $6,700. That's a loss right there of 2.36%. Then the next year, we see we get our $150 back plus another $3,600, and it gets better and better each year when we look at the cash value growth. Remember, if we do it right, it's tax-free. It's also without any risk, which is good. And I can also access the money while I continue to receive this compounding. This is why people are interested in it, and this is how people use it all the time, but especially in a recession or in a down market when opportunities are available that are going to yield me a much higher return. So to wrap this guy up, let's take a look at an example here. What we've got is as follows. On the left, we've got the same illustration we just looked at. This is the funding. Policy values, $600 over 4 years, breaks even between years 4 and 5. Okay, fantastic. LTV represents the maximum loan you can take. It's 95% of the total cash value. Here in year 4, we're pretending we've got an opportunity. Say it's a piece of property. You need $500,000 to acquire it. You've got that available in your cash value because you've built it up over time. Take that $500,000 loan, the interest rate, 5.7%. Here is the important piece right here. Comparison. Let's get everything else out of the way. Okay. This is going to show what your policy is growing by compared to what you are paying in interest. So the year you take out the loan, $500K, your policy earnings were $11,000 and change. The interest paid to the insurance company, $28,500. You paid more in interest to the insurance company than what they paid you in total dividends and interest. The next year, very close. Third year, you're coming out ahead. Now, what's also happening, that loan balance is coming down. The reason why is because we are repaying it at $50,000 per year toward the principal. So to be clear, we're paying the loan interest plus $50K per year toward the principal, which we can pay it back however we'd like. In this example, I plugged in $50K to pay it off in 10 years. That's the main reason why. And then also looking at this, when you take that $500K loan, there's your death benefit, $1.55 million. Look at the death benefit before you take a loan out, $2,050,000. What's the difference? $500,000, the amount that you borrowed against the policy. So how people will use this is one says, okay, I can continue to earn this compounding here on my full cash value. So if I'm going to earn this along with the tax advantages, and I can use it for opportunities, which are going to yield me a much higher return than I'd get in a policy or probably anywhere, because that's my thing if I'm putting money there. Well, now I can continue to see growth here. Yes, I do have a cost to borrow. We need to account for that, but I can compare it with these two columns. But this continues to cash flow, and when I repay this loan, I see my cash value restored, and I've got access to all of the equity, just like a line of credit when it's restored, also assuming that the appreciation on the property that I owned continued to appreciate over time. Hope that made sense. Let us know your thoughts. I hope that this video was helpful. We'll talk to you soon. Thanks again. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.